Our next guest is a bear no more and hasn't been for several months. Steve Leuthold is manager of the Grizzly Bear Fund. Last January, he admitted that things didn't look quite so grisly anymore. Now his Leuthold Core Fund is up 24% in the last year, and his Leuthold Asset Allocation Fund is up 17%. Steve Leuthold is chairman of Leuthold Research, and he joins us live from St. Paul, Minnesota. Steve, good to talk with you and have you back on the program.
Betty, nice to be back with you.
Okay, so I was reading, Steve, your latest report for the month of October, and you were saying that you expected some type of correction in October, a rest for the markets, and then we would be set up for a pretty big, possibly a big November-December rally. The fact of the matter is the S&P is actually up so far by 2% for this month. So does that bode well, then, that we're going to get a pretty strong rally towards the end of the year?
Well, it really surprised me. I thought October would be kind of a lateral month or maybe a correction month, but so far it's been pretty good, although we'll have to see what happens from this point on. Either way, I think we're setting up for a really good market in November and December, a year-end rally where you're getting kind of a forced move into the market by those that have lagged behind. You're coming up to year-end and kind of a capitulation on the part of the people that have been cautious.
And a rally to your target level, is that right, of 1,200 on the S&P?
Well, that seems to be a common target now. It was ours about 6 months ago.
It was?
But,
yes.
Yeah, but I think that up at that point, we are going to be selling around 19 times earnings, 18 times earnings. So that's it's not terribly overvalued, but we're getting toward overvalued territory.
And Steve, correct me if I'm wrong, but you had talked about the possibility of getting to 1,500 over an 18-month stretch, and you had a wish list, no new stimulus, consumer spending growing, a whole host of other things. What is working on that wish list in terms of seeing continued growth for the stock market?
Well, we kind of revised that down to 1,300, 1,350 as being a high next year, but we don't think it'll end the year there. But that puts us up at a pretty high multiple, and I think undoubtedly the performance in 2009 is going to be better than 2010.
You think we're going to end the year next year where, then? How much below the peak?
I don't know. I'm a little concerned about the last half of next year because we're getting up to the point where there's going to be expectations on bringing the budget deficit down, on bringing in some of this huge amount of excess liquidity that's swamped into the system. And if that doesn't happen, I think we could have some trouble ahead for the last half of the year.
Okay, Stephen, the time that we have, though, and we'll bring you back after the break. Earnings, though, do they give you any reason why you think that this rally is going to last?
Well, the earnings, I mean, it's kind of like Lake Wobegon. Everybody's above average and everybody's beating their estimates and so on. So,
yeah, I mean, and they were low, and some were lowballing their estimates, and they've been very easy comparisons too.
Sure, there's been a lot of game playing there. I mean, everybody wants to beat their estimate. Everybody wants to beat their projection, and that's what we're seeing here. So I think the earnings are good. They're strong, but I think the corporations are gaming us a little bit.
That's interesting. Okay, Steve, well, we're going to continue that conversation after the break, talk more about earnings and also why he sees perhaps the beginnings of a secular bull market after the break. Well, in today's movers and shakers, new proposed internet regulations are turning enemies into allies. Verizon Chairman Ivan Sittenberg criticizing an FCC plan to open up the internet. Sittenberg says the so-called net neutrality rules would be a mistake. Verizon's competitor AT&T has also come out against the proposed regulations, and we're going to head to Washington for more on this showdown in just a few moments. And Twitter chief executive Evan Williams making moves that could help his site make some money. Twitter made 2 separate deals with Microsoft and Google to make tweets searchable. In terms of these deals, or the terms of these deals, were not disclosed. Okay, we are back with Steve Leuthold. He's a fund manager and chairman of Leuthold Research. And Steve, I wanted to just carry on that comment you made just before the break about, these earnings coming out, gaming the system possibly, or at least, in my view, a lot of noise going on with these earnings results. When then are we going to actually get normalized earnings? When are we going to see a clear picture of the earnings on the earnings front?
Well, I think you'll probably get a better indication next year. Right now, you've got a lot of bounce. You've got a lot of I think, guidance that is under-guiding to make companies look good. But I do think when we talk about normalized earnings, we look at earnings over, say, a 5-year span, so we iron out the business cycle. And right now on the S&P, that gives you about $65 earnings. And that probably isn't going to go up much over the next couple of years, because the ones we're knocking off 5 years ago and 4 years ago are pretty strong earnings. So I think there's a limitation on how far this market can go on a valuation basis, and I think we've got to wait a while before we're going to go above 1550 to new all-time highs.
Hey, Steve, it's Adam. FXI, the China ETF, your #1 holding as of June 30th. Obviously, great numbers last night. Does this freight train keep going, or up 60% year-to-date? Do you take something off?
Well, you know, I think when we look at the dynamics of the foreign economies compared to the U.S., it still looks like a very good place to be, whether it's China or it's some of the other parts of Asia, or even, if you want to shoot a little craps, maybe Russia. But we have half of our equity portfolio is invested in companies domiciled outside the U.S. So we're quite dependent on the faster economic growth outside the U.S. And, of course, when you look at the S&P, about 40% of their earnings are from abroad, too. So that's where the action's going to be.
But China, though, I mean, in and of itself, where, though, would you find the most value in China?
In China? Well, we've tried to focus, and it's hard to find the stocks. We actually are doing individual stock research in China, and we're looking for the consumer stocks rather than the exporting stocks. And we're also looking at healthcare, where there are very few publicly held healthcare stocks in China. But that's we view more of the growth in China to be internal consumer growth rather than export growth in the next round.
Steve, we know you like some technology names, IBM, Oracle. Tell us why.
Well, actually, I'm pretty disappointed because we had a big chunk of the portfolio in what we call Big Ten Tech. These are the largest companies. And with our disciplines, they about 2 months ago, or about a month ago, moved to a sell zone, and we've replaced them with smaller tech companies that we think are perhaps buyout candidates. These big tech companies are loaded with money, and you've seen the acquisition starts with Dell and others.
Like
I think
who?
that's going to
Like
continue.
Who? Steve, like who? Can you give us a name?
I don't think the lawyers want me to give names.
Okay, well, it was a good try. All right, Steve, we're going to be with you after the bell. So just stick around for us. That was Steve Leuthold, and we'll be back with the opening bell. Okay, well, stocks are trading higher, or mostly higher in the early moments of the session. The Dow up by 30 points, the S&P higher as well. Leading the way, telecoms and financials. Okay, we are back with Steve Leuthold, chairman of Leuthold Weeden Research. And Steve, one final note about equities. As I have heard, I've heard this rumor that you may be turning into a perma bull. Is that right?
Well, I was known as a perma bear for 1998, 1999, and 2000. And now, no, I'm not a perma bull. The key to this business and the way to survive in this business is to be flexible. And that's how I've stayed in this business for 48 years, by being able to change my mind.
Wait, so, but so are you, or so you're not, but you do see the start of a secular bull market. How do you reconcile that?
Well, I see the start of a secular bull market maybe out 3 or 4 years, but we're going to see some backing and filling in a couple of cyclical bull and bear markets before we can take off to new high ground. So okay. I'm quite cautious about the next year. So
darn, I was hoping you changed your stripes.
Well,
okay.
And given that hint of caution, Steve. I know that you look at gold, that you invest in gold, that you may invest more in gold. This week, David Einhorn of Greenlight Capital said he likes to go out and just buy the physical stuff, gold bars. How do you play gold? Do you like the ETF route? Do you like the gold mining stocks? Or do you just like to stash a bunch of bars?
We buy, for the most part, for our mutual funds, we buy the physical stuff, and it's up at the Royal Bank of Canada, and we could go up and look at it if we want to. So we want to go to 10% gold eventually, but I'm not going to chase it at these kind of prices. We're about 2% gold, 1% silver right now, physical.
Hey, Steve, it's Adam. Since September 1, the gold mining stocks up twice as much as gold. And, of course, gold's had a run. Gold mining stocks now up about 40% year-to-date. Do you consider shorting gold miners against gold perhaps as a hedge, or do you just go long gold and just let it ride?
I think that's a little fancy, and from our standpoint, we view the gold as being somewhat of a hedge, just like our foreign stock holdings against dollar debasement, against monetary debasement inflation. A run on the dollar.
Steve, somewhat related to all of what we're talking about with gold and inflation, you're shorting treasuries, is that right?
That's right.
So you are all throughout the yield curve, or what? I mean, where are you exactly short?
Well, I think I'm looking at treasuries, and I'm talking about the 10-year, and I'm talking about the long bond, and we're short in the hedge fund, and we've got some of our fixed income hedged in the mutual funds. And I think rising rates are actually a positive because it indicates a return to normalcy. And right now, I think you're going to see a return to normalcy. I think you're going to see higher long-term rates with treasuries, maybe not with corporates.
Okay, interesting. So there you go. Somebody who is returning to normal and also possibly worried about inflation. So gold and treasuries. Okay. Thank you so much, Steve. Steve Leuthold, the chairman of Leuthold Research. Well, we're about